The opening bell on Dalal Street rarely rings into a vacuum, but some trading sessions defy immediate domestic data, forcing us to look elsewhere. This chart tracks the Sensex during a highly erratic open. From a previous close of 77,303, the index gapped down heavily, shedding hundreds of points to a floor of 76,973. Then, without domestic catalysts, it violently reversed, spiking into the green zone at 77,335. Financial media rapidly classified this oscillation. The prevailing narrative broadcast to retail investors was that the Indian market was simply confused. This movement represents the cold algorithmic repricing of a specific global macroeconomic risk occurring in real time. The data driving these sudden liquidations and immediate buybacks was not generated in Mumbai. The catalyst originated roughly 1,500 miles away in the Middle East. Negotiations regarding a U.S.-Iran ceasefire had stalled. The diplomatic channels froze, leaving the immediate security of global shipping lanes unresolved. The United States leadership dictates the temperature of this geopolitical standoff, weighing proposed resolutions against regional strategic interests. When talks pause, the risk profile elevates. We are going to trace the exact mathematical mechanism that connects a stalled diplomatic conversation in the Middle East to the sudden destruction of wealth in specific Indian equities. Tracing this macro to micro transmission is how institutional capital capitalizes on sudden volatility, while retail investors are left reacting to the noise. The first tier of this causal chain requires looking at physical geography. This is the Strait of Hormuz, bordered by Iran and the Arabian Peninsula. It is the single most critical transit artery for the global energy sector. Roughly 1/5 of the world's daily oil consumption passes through this specific bottleneck. Any threat of a physical blockade here is a binary shock to the global supply chain. The flow of energy either continues or it stops. Massive industrial assets, carrying millions of barrels of crude, are forced to navigate directly through the crossfire of this escalating tension. The operational status of the Strait of Hormuz acts as the fulcrum upon which the entire global energy market balances. That physical vulnerability is immediately translated into a dollar value via the global commodities market. As the ceasefire talks stalled, global crude prices reacted instantly, surging upward and pushing toward $110 per barrel. This chart illustrates the geopolitical risk premium. Markets don't wait for a waterway to close. They mathematically price in the probability of a closure. That premium inflates crude futures instantly, spiking prices long before physical oil is delayed. $110 crude is the mathematical transmission vector. It forces the reality of a Middle Eastern conflict directly onto the balance sheets of corporations thousands of miles away. This brings us to the third tier, how a global oil shock systematically attacks an import-dependent economy like India. India imports the vast majority of its crude oil. When the price of that commodity violently spikes, the national import bill immediately expands, widening the country's current account deficit. A sudden expansion of the current account deficit acts essentially as a forced, unavoidable tax levied directly against the domestic economy. That dynamic triggers a secondary macroeconomic penalty. Expensive oil pulls severe inflation directly into the domestic supply chain, driving up the cost of manufacturing and transport. These structural vulnerabilities guarantee a violent market reaction. It sets the perfect stage for algorithms to target and liquidate specific exposed equities. We can observe this targeted liquidation in high operating cost sectors. Consider aviation, led by market-dominant carriers like Indigo. The operational math is rigid. Aviation turbine fuel constitutes roughly 40%. They are rational, mathematical, algorithmic adjustments executed to account for severely compressed corporate margins. This tick-by-tick model tracks the Nifty 50. Notice how it drops below 24,000 and then instantly executes a partial recovery. This specific type of high-frequency oscillation is driven by automated hedging mechanics. Automated trading systems process these news terminal flashes regarding ceasefire probabilities in mere milliseconds, continually updating the portfolio's risk parameters on the fly. As those probabilities shift, the algorithms rapidly switch portfolio positions between risk-on and risk-off assets, constantly hunting for a fair value equilibrium in an unstable environment. The volatility signals the highest level of computational pricing precision, functioning exactly as designed to locate fair value. This diagram maps the complete transmission mechanism. A physical geopolitical choke point dictates the commodity multiplier, which subsequently forces a macroeconomic squeeze on the domestic index. The volatility witnessed on the floor of the Bombay Stock Exchange is entirely symptomatic of the unresolved tension at the Strait of Hormuz. In a globally integrated financial system, attempting to assess risk by looking solely at domestic economic data is completely insufficient. The order book and valuation of an Indian large-cap stock are mechanically tied to the geopolitical reality of the world's most contested waterways. True market intelligence requires understanding the physical geography and the political conflicts lurking beneath the financial data.